Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Fight of the Century, hosted by Old Capital. I'm Les Meisel, your host and fight promoter for today. In a few minutes, we will introduce our main event. But first, this fight has taken years, and I mean years to arrange. Fannie The Legend Mae has been the standing champion for decades in the small balance apartment loan arena. Yes, there have been a few challengers, like the community banks and credit unions, but nobody that was a real challenger. They were the only game in town, and they knew it. But in the last 24 months, a spunky new challenger has been born. A scrapper, Fightin Freddie Mac, has come on the scene. Some say that Fannie Mae is over the hill, too fat, too slow, not creative enough to handle the apartment lending market today. That's not what we say. Freddie is the kid, the newcomer, the one that may have a few tricks up their sleeve. Today, they lay it all out. They both come with chips on their shoulders and with the sole purpose to earn your business. And now, let me introduce a man that needs no introduction. He is the godfather of apartment financing, and now the Don King of the fight of the century, Mr. Paul Peebles.
Ladies and gentlemen, investors and investees, welcome to the Fight of the Century. I'm your ring announcer, Paul Peebles. Today, your fighters will show a brilliant display of lending ideas. This fight is not sanctioned by the Texas Boxing Commission, nor the City of Dallas. It is for your benefit only. Remember, no wagering. In a moment, we will bring out both fighters, but first, let me tell you how this is going to work. Each fighter will have 15 minutes to explain their program. A flip of the coin will decide who goes first. After both fighters have explained their programs, we will turn to the audience, which is James Eng, and answer any questions that you have, and we'll ask him how he scores the fight. So let's get ready to be humbled. So let me bring out the gentleman in the blue. He's weighing in at 165 pounds wet. He's the current champion. That's Fannie The Legend Mae.
Hey, Paul. Thanks for having us here.
So let me give you some statistics on Fannie The Legend Mae. So 53% of his business is acquisition. 35% of their business is under $5 million. 47% of his business is between $5 million and $20 million in loan amounts. And 29% of the loans are for tenants that make less than 60% of the average median income for the area. And then 49% are for tenants that make between 60 to 100% of the average median income. Why that's important, Fannie Mae really stresses looking for properties for affordable tenants. In the Dallas Metroplex, Fannie Mae does 4% of the entire business. There's 25 DUS lenders in the United States, and today we have Fritz. And so in the red, weighing in 205 pounds, it's the challenger, Fightin Freddie Mac. Fightin Freddie Mac. Let's give some great statistics on Freddie. As of July of 2016, they've done $27 billion in origination for the large and the small balance loans. They've returned over $427 million in income to the U.S. taxpayers. Freddie has financed over 357,000 units in the first 7 months of 2016. 9 out of 10 of their transactions support affordable housing. Remember that B and C. They now control 54% of the market share of the GSEs. But I think these are the important statistics that Freddie Mac has today. They only have 1 basis point of credit losses, 2 basis points for current delinquencies, and 1 REO, which is a foreclosure, in the entire U.S. Only 1 REO in the entire U.S. So let me introduce Freddie Mac. That's John with Freddie Mac.
Hey, Paul. Thanks for having me.
So let me go back to Fritz. How do you feel tonight? Do you see any weaknesses in Freddie?
I think we got plenty. I feel pretty confident we'll come out on top at the end of it.
So, John, what's your strategy for tonight? Are you a one-punch knockout, or are you going to go the distance?
You line them up, I'll knock them out.
All right, guys. Are you both ready?
Ready to rumble.
So a flip of a coin indicated that Fritz is going to go first. So, Fritz, I'm going to kind of let you kind of talk a little bit about Fannie Mae.
Sure, Paul. Thanks again for having us here on the podcast. We're excited to be with everybody. So to stay consistent with the boxing theme for today, I kind of broke this out into rounds. So I don't know if we'll make it all the way to 8 rounds. I think we'll have a knockout by maybe round 8. So to start it off in round 1, one of the biggest differences between Fannie Mae and Freddie Mac is just the general business models, right? Fannie Mae models is called the DUS model, and that stands for Delegated, Underwriting, and Servicing. And there's, as Paul said earlier, there's 25 DUS lenders across the country that they have the ability on a delegated basis to originate, underwrite, close, and service all their loans without prior approval from Fannie Mae. And that's different than Freddie Mac and FHA HUD, which are the other government-sponsored entities. And the reason that Fannie has, they allow their DUS lenders to underwrite their deals and close them without really even getting any Fannie's approval is because we're in a risk share, or we take a loss share position on all of our deals. So, if we have a credit loss, the lender is at a loss along with Fannie Mae, where on Freddie Mac deals or FHA HUD deals, the lender, the group originating the mortgage, they don't have any loss sharing. So obviously, Freddie Mac and HUD want to underwrite those deals a little more closely on their end, where Fannie Mae gives us a lot more authority to make those decisions. On to round 2. Now, with the DUS model, it allows us to obviously have more control over the loan process. And something we do on our team with our loan committee is we present to all of our loan committee members up front before issuing you a loan application. It's really important to us on a lot of these, in particular on these acquisition deals when you may have money going hard from day one, that you want to make sure your lender doesn't leave you at the altar with significantly different terms. So it's important for us to get in front of our loan committee, up front. So when we issue that loan application, it really means something that, we feel really comfortable with the deal. We've looked at who the sponsorship group is, where the property is located and the general deal metrics, things that really shouldn't change throughout the process. Now, there's things that can, change, things in survey title that you can't foresee, but the general deal metrics you should be able to take a look at up front and feel pretty good about. So all those loan committee members are seeing this deal 4 to 6 weeks before loan committee. So when that time comes, there shouldn't be any surprises. On to round 3. Fannie offers a lot of flexible loan options, ranging from on the fixed rate side and variable rate options. On the fixed rate side, it can range anywhere from 5-year terms all the way up to 30-year terms. Most commonly, all the mortgages are 30-year amortizations as well. And all the fixed rate deals, for the most part, have yield maintenance attached to them. So, I've done deals 5, 7, 10, 12 recently year terms. I've done a 20-year fully amortizing loan in the past year because that's what the borrower was looking for, and we were able to securitize that security at a pretty good interest rate. So a lot of flexibility, and these are decisions you don't need to make up front. So when you sign that loan application, say you were thinking, maybe it's a 10-year term was what's going to be best for me. But then later on, you look at where the rates move as you get closer to rate lock, and you decide for your investment group that maybe a 12 or 15-year deal works better for you. And we can work with you throughout that process. Fannie did just come out for some of their fixed rate product, like declining prepayment options for properties between 5 and 50 units, as well as some affordable properties. So it is a slightly higher interest rate, but it gives you that flexibility, that step-down prepayment structure if you don't feel comfortable with the yield maintenance calculation. Other than the fixed rate side, they do offer variable rate product, Fannie does. And the most common product is called a 7/6 ARM. It's a 7-year loan term with a 1-year lockout. And after that 1-year lockout, it's a 1% prepayment penalty thereafter. This is basically Fannie's bridge loan product without being a bridge loan lender, but it gives you flexibility if you're looking to sell the asset. Say you want to do, some rehab, but are looking maybe to sell the deal in year 2 or 3 instead of holding it long term. This can be a really good option for you. The one caveat with it is we are allowed to go up to 80% LTV on an acquisition similar to a fixed rate deal. But normally for our underwriting criteria that we have to use per Fannie Mae, we usually get constrained to 75% LTV. So you may sacrifice a little bit of loan proceeds up front, but you get the flexibility in the back end when you're looking to sell that deal. Round 4, all of the Fannie Mae products are assumable, and you can get a supplemental loan on top for each of those loan products. So obviously on the supplemental side, if you have an assumption, you can get up to 75% LTV. And I actually get this question quite often. At what point does that leverage change? So if there's more than 7 years remaining on the loan term, you can get up to 75% LTV. If there's between 5 and 7 years remaining on the loan term, you can get up to 65% LTV. And if there's less than 5 years remaining, it's very, very difficult to get approval from Fannie Mae to get a supplemental at all. It's just too close to when the balloon is due and they don't feel comfortable adding on more debt. You can also get supplementals for your existing group. Say you buy a property, you do a great job rehabbing it, push rents, and you're looking to cash out for some of your investors. We can do a supplemental loan up to 70% on a cash out supplemental for you and your investors if you're looking for that after the first year. Round 5, I know I mentioned this earlier briefly, but Fannie Mae does allow in their loan products to roll in your rehab into the loans. So Fannie allows up to $10,000 a unit that you can roll into your loan proceeds. Basically, when we look at this deal, we order 2 appraisals, one an as-is appraisal, and the second being an as-renovated appraisal that takes into account the work you're going to be doing on the property. And then we use the lesser of that as-renovated appraisal or your purchase price plus your rehab dollars. So normally I would say in most cases it ends up being the purchase price plus rehab dollars because usually there's some profit built in there if you do a nice job and do the renovations. Your appraisal, your as renovated appraisal should come out to be more than you're spending on the property. One thing to note, Fannie Mae, we cannot underwrite future income. So say you're going to do some interior upgrades at the property, we cannot count those rent bumps into your net operating income. So we can only use that in place rents. So something to remember on that as well. So a quick example, say you have a $10 million purchase price, 200 units, and you're going to do $1 million of rehab, which ends up being about $5,000 a unit. Your as-is appraisal comes in at $11,250,000, but your all-in cost is $11 million. Your max loan for this transaction would be $8,800,000, which is 80% loan to cost and an 88% loan to purchase price. So you can get that extra $800,000 in loan proceeds, which doesn't force you to raise that extra $800,000 through your investor group. Those rehab dollars, however, do need to be escrowed for at closing, and we hold them internally with a lender. And all the work is required to be done in 12 months, but we can work with you on some items, especially interior upgrades, as you get close to that 12-month period to get some extensions, because we understand sometimes it's hard to kick out tenants. Round 6, Fannie Mae is always coming out with new programs to make themselves more enticing with borrowers. And the most recent one they're really pushing is the Green Rewards program. So you can earn up to 33 basis points off your interest rate and up to 5% more in loan proceeds. Basically, what you need to do is reduce your property's energy or water consumption, either one, by 20%. And we can underwrite up to 75% of those owner savings and 25% of the tenant savings. This is available for acquisitions, refinances, and supplemental loans. So basically, we just order an extra report that costs about $6,500, and the group will come in, take a look at kind of the bones of the property, and figure out and give you recommendations on things you can do to save 20%. And actually now Fannie, they're really pushing the product that if you go forward with the Greens program after the loan closes, they will refund you the cost of the extra report you have to order. So they're really making sure that really pushing this program and making it more advantageous for borrowers to go down this path. Round 7, and I think this is probably the last round, we have in-house servicing throughout the loan. So life of loan servicing, which is, in my opinion, the most important part of the loan process. You'll deal with myself for 45 to 60 days normally, but then you end up working with the servicing group for 10 years. A lot of times they do a 10-year fixed loan. You end up working very closely with the loan servicing group. So I think you really need to look closely on picking a business partner that you feel comfortable with as you work through those, especially if you're doing a rehab property. For example, say you want to do about $15,000 for upgrading the basketball court. And it says in the loan documents that you have to do $15,000. Black and white says has to get done in the first 12 months. Well, say after you purchase the property, it's 3 months into it and you realize, well, maybe it's not best suited to spend that $15,000 on a basketball court. Say you want to put that $15,000 towards upgrading the pool facilities, and you can make a case and let us know, and we can push that through to Fannie Mae and get that approved. Obviously, you just need to have a good reason on why you're doing it, but we're willing to not exactly see those loan documents as black and white all the time. There can be some gray area. We want to make sure as your biggest business partner, and a lot of these deals owning 80% of it, of providing 80% of the capital up front, that we're being your best business partner long term. So in conclusion, the knockout punch, I believe Fannie's better than Freddie because the DUS model allows the lender to make all the decisions internally, and we have the ability to roll in rehab into loan proceeds. They're always continuing pushing new products, for example, the Green Rewards program. And finally, the in-house servicing allows us to be your best business partner long term. So with that, I'll throw it back to Paul.
Boy, a couple jabs at the chin, a couple belly shots. I don't know if he can recover from that, John.
I got this.
Let me hear it. Come on, baby.
I got this. Thank you, Paul. So I guess a few things at a very initial level that we should touch on because Fannie's has brought them up. Like Fannie, we also service our loans, but unlike Fannie, the Freddie process is a little bit different. Everything that we bring in, we underwrite in-house, and then we need to send to Freddie for approval before we can fund the loan. So what ends up happening is the loan is underwritten twice before you will have funding on the deal. How that correlates to the borrower is typically we're a little bit more open-minded. Fannie's going to likely be a little bit more conservative because they're taking a little bit more risk up front versus we receive pre-approval from Freddie before the loan's funded. So we can look at a few different things. The second element that I want to clarify is unlike my Fannie counterpart here, I'm focusing on these smaller deals. So I am one of the 12 licensed partners on the new Freddie program. It's a small balance program. And the bread and butter of that program is $1 to $5 million multifamily and mixed use loans. We can go above $5 million in select instances, but really we try to keep most of the loans in that $1 to $5 million bucket. So that is, I guess, on a high level, two of the differences initially that I want everyone to keep in mind. So moving into the program, the Freddie Small Balance Program is relatively new. It came out roughly about 2 years ago. And really the program, although we do compete with Fannie a lot, is meant and it's almost tailored to look and feel and compete with the bank loans. So a few of the key differences that you will see in our program that are unlike the Fannie program is the first is going to be the biggest, I think, is the step down prepay. Unlike Fannie, we price every single deal on a step down declining prepay schedule. What that looks like to you on a 5-year term would be 5, 4, 3, 2, 1. If the borrower elects to do a yield maintenance, he will just save on his interest rate anywhere from 15 to 20 basis points on it annually. So that is one of the key differences, unlike Fannie, where they typically are pricing on yield maintenance. The second is we are pricing on an absolute coupon basis. So when I send you an application, I will have one quote on there, which will be a coupon, which includes a free rate lock for 45 calendar days, give or take. And what that has is that's already taken into consideration the index and the spread to the lender. So you won't have to worry about an index lock or a spread lock or whatnot. As long as the underwriting is where we have initially sized it to, your rate will be held. And all we have to do is submit the deal to Freddie within 45 days for final approval. And the borrower does not have to pay anything additional for that rate lock. Some of the other cool little intricacies of the program is a lot of the loan docs and the third-party reports are abbreviated. We don't do a phase one initially. The only two third parties that we will be doing is a abbreviated property condition report, where in that we do a chain of title. We research the chain of title, and if there's some sort of environmental issue, then we cross that bridge when we get to it. But I'd say 90 to 95% of our deals, we don't need to go down the road of a phase one or God forbid, a phase two. And then second, we do an abbreviated appraisal report, and that's it. But we're trying to really streamline the process and get these deals in and out of the system as quickly as possible. One of the nice things about that is it allows us as a lender to keep our costs fairly competitive. And we work very hard to keep those costs at a very competitive rate to what you would see similar to a bank loan and less on what you would see on a CMBS or a larger agency loan. So those are three of I really would say, the defining features of our program. One other key feature that is pretty nice about our program is we don't require previous multifamily investment experience. As much as I would love to see that, and that definitely will help the credit quality and the file, as long as you fit the credit parameters, and by that I mean the net worth and liquidity requirements, and are hiring a local experienced third-party management company, Freddie it allows us to lend to those sponsors. And that's one of the features that you will see on the small balance program that you likely will not see on a Fannie deal or on a handful of other deals. So we're really trying to be inclusive to people that would be first-time investors, but then also guys that maybe have 5,000 units in their portfolio. Moving into some of the features of the program, there's two sets of mortgages that we have. It's the standard fixed-rate mortgage on a 5, 7, and 10-year fixed. All the pricing is based on a 30-year amortization schedule. And then we have a second program, which is known as a hybrid program. The hybrid program, the best way to think about it is similar to conventional or a home loan, where you have a fixed to floating period. So one of the unique features of this program is that everything is based on a 20-year term. So you can, as a borrower, while we're pricing the deal, you can select a 5, 7, or 10-year fixed period. And then for the remaining of that 20-year term, it will float at a spread over the 6-month LIBOR. The loan adjusts every 6 months, and there's a 5% lifetime cap, which will cap it at 5% over your initial fixed rate. It's a really great option because it provides you some optionality there at the end in case for some reason when you go to refi or sell the property, for whatever reason, there's not competitive capital in the marketplace. During that floating period, there's a 1% prepayment penalty, but that is waived if you refinance into another Freddie deal or if you sell the property. Getting into loan to value, most of the loans that you will see in standard and top markets, we can go up to 80% on loan to value. As you start to get into more secondary and tertiary markets, it will start to limit you down to 75% or 70% loan to value on a refinance. One of the features that we are seeing a lot now is sponsors looking for a loan to cost refinance, having owned the property for less than 2 years. Freddie is, depending on the length of ownership, I would say the over-under, the hurdle that you're seeing is 2 years. So after 2 years, it can be a straight loan-to-value refi. Under 2 years, what we're seeing right now is ownership that's under 12 months. You're going to be capped at 80% loan-to-cost. And then between 12 to 24 months, it's going to vary based on the story, the sponsor, the strength, the balance sheet of the sponsor. So we will take into consideration a handful of things. The stories that we tend to like more would be a sponsor that's put in, $500,000 of CapEx into the property, and he's really grown his top line. At the same time, he's really streamlined some of his expenses. So he's done some meaningful heavy lifting on the property. Not to say that I won't entertain the sponsor who bought the property and there's just been cap rate compression, but I am definitely interested in the story, and I'm going to look at it on a holistic level. Freddie does offer interest only on our deals. On a 10-year, you can get up to 3 years of IO for no additional cost. And you even have the option of doing full-term IO on our loans. Full-term IO, you will just be capped at 65% LTV. Your minimum coverages are going to range depending on your markets, but it's clearly defined. So we will lend in all 50 U.S. states. I believe we're looking at a deal in Alaska, and we have one that we recently did in Hawaii. So we'll go everywhere, but typically your coverages are going to be a 125 or so in most standard markets. In terms of credit, we're looking for a 650 FICO score. That's not to say that I won't do some deals that fall below that. Again, we just need a good story and a reason why we should do that and what the circumstances were. In terms of sponsor financials, what we're looking for is roughly about 1 times the net worth equivalent to the loan amount, and then about 9 months of debt service liquid. And then one of the newest things that's been happening in the program is that we're looking and we're heavily weighting some of our pricing towards workforce housing. So don't like to call it low income housing. It's based on a certain percentage of the median income, and also if there's median rents that fall below what it will be for that zip code. What we try to tell people is send us your rent roll, clearly defined with 1, 2, 3 bedrooms, and we can run that calculation and let you know if it qualifies or not. But if it qualifies on 7 and 10-year loans, you can get up to 50 basis points off on pricing. So it's a meaningful amount. And I guess getting into some of the more common questions that we've received on the program here. First thing, we can easily handle sponsorship structures that are trusts or potential entities where there is no warm body carve-out guarantor We've done a handful of these deals in select circumstances. Again, we look at each deal individually. We like to see how the property underwrites, and then we consider whether or not we can go down that road. Student housing and military housing, what I tell people is as long as 50% of your rent roll or less is students or military, then it's something that we can consider. Once you start to get above 50%, then it may not be the best fit for our Freddie Mac program. Land use restrictions or deed restrictions, that's a newest change to the program. It's something that we will be pre-screening, but we have been given the green light to go ahead and size and close on loans that potentially have a certain number of units set aside for affordability. Again, it's something that we're going to be taking a look at the story, the restriction. Less intrusive is always better. More details are always better. I would say work with Paul and the rest of the guys to provide them with as much detail as possible, but we can work with you on those. Manufactured housing is a yes. What I like to tell people, though, is think about it more as cardinal housing and not so much mobile homes. We can't do mobile home parks right now. We can blanket properties. So if you have a handful of properties that are within a mile or so of each other, and they are all standalone at 5 units or greater, we can blanket them onto one loan. Again, it's something that we're gonna pre-screen those deals a little bit more, and we like to get the idea that they have been run as a portfolio, and it's not just a handful of properties that are randomly pieced together to try and fit into the program. Can we lend on deals that are less than $1 million? This is a very, I guess the best way to put it, this is a very interesting question. It's not something that I'm going to term sheet on a loan less than $1 million. If it falls below $1 million for some reason in underwriting, then we will entertain doing a deal, I'd say as low as about $750,000. Again, we're going to take a look at all the other circumstances, but we're not really going to be going out there and term sheeting deals that are less than $1 million. We try to draw the line at $1 million. Short-term floating or bridge products, we don't offer on this program just yet. We do not do supplementals on this program. One of the other interesting things that we are seeing is people that are coming to us on pro forma income. Maybe you're buying the property at a great deal and you think the rents are 20 to 30% below market. That's great. I love to see the pro forma, and I'm going to ask about it in my underwriting package, but I am an in-place lender, and I believe my counterpart here at Fannie is an in-place too. So although we like to see the great story, in-place income is what we're going to size the deal off of. Now, in terms of in-place expenses versus pro forma expenses, there's a little bit more leeway there, especially if you're a seasoned investor in that marketplace that can show that he's got a track record, or he or she has a track record of taking these undermanaged properties and streamlining the expenses. That is something that we can put a little bit more weight on. Escrows. This is one of the interesting features of the small balance program. We do not reserve on any loan as a standard for insurance or replacement reserves. We don't hold back on those. The only thing that we will hold back on is for property taxes. However, with that in mind, if your loan to value is below 65%, we won't even reserve for property taxes. So all three of those, property taxes, insurance, and replacement reserves, will be the responsibility of the sponsor, and the servicing arm will not hold back for those. And then one of the final things that we do get questions on is tax returns. We do not require tax returns for underwriting, so we don't need to see what you may or may not be reporting to Uncle Sam. But those are some of the interesting features of the Small Balance Freddie program. And with that, I turn it over to Paul.
Unbelievable. Some jabs to the face, a couple kidney punches, a bloodied lip. He means business. That guy over at Freddie means business. Let's turn it over to somebody who really means business, and that's James Eng with Old Capital. He's a number of questions to ask on behalf of the audience. Let's kind of hear what James is thinking.
Let's start off with maybe some scenarios and walk through some, if this was my deal, how you guys would approach it. I think we've gone through a lot of data on the loan programs. So let's just start off with, let's just say a Dallas deal, 50 units, $3 million. What type of questions are you asking me as the owner going into this deal? And let's figure out what type of sizing and structure we would have on something like that. So $3 million, let's say 250,000 in rehab, 45 units, 50 units here in Dallas. What would you offer on terms, something like that?
So from the Fannie side, I think knowing that it's in Dallas, we feel really comfortable. Fannie feels really comfortable in obviously in the Dallas market. We could go up to 80% loan to cost. So rolling in that rehab, assuming that it's, truly value add, if you're doing improvements, sometimes if it's deferred maintenance and it's really not going to provide any value to the property, sometimes we'll push back on that a little bit, but the appraisal would confirm that. It's under 50 units, so it's going to get great pricing from Fannie Mae. You're probably, under 4 today, under 4%, close to 4% today, probably on that deal. So we'd love to take a look at it.
Oh, that's a pop from Fannie Mae. How would Freddie Mac look at that?
I mean, how quickly can I term sheet the deal? I guess, initially just to size the deals to give everyone an idea of what we look for. It's just maybe 1 or 2 years of financials, a rent roll, and a little bio on the sponsors. Some sponsors are a little bit more hesitant to give us financials, but we do like to get as much detail as possible, have an idea of how the property looks and where it is and how well it'll show. In rate and terms, you're going to, on a 5, 7, 10, you're going to be underwriting to a 125 coverage. I can go up to 80%. We have, in select instances, been able to roll up to 3% of approved closing costs into deals. That is going to be very much so driven by your engineering report and your appraisal. So 80% is what I tell most people, with a chance of going above. On a 10-year, if it has affordability, you're probably going to be about, 415, 420 on a 10-year fixed with 3 years of IO because it's an acquisition. And
3 years of IO, 3 years of IO, okay.
Which is great, especially if you're going to be doing some renovations up front. That's more money in your pocket to help on the renovations of the property.
So you might have to raise a little bit more, it sounds like. So you're going to be going 80% off of $3 million purchase price.
Correct.
Whereas Fannie would roll in some of the rehab into it. And then in terms of IO for Fannie on something like that, what are you thinking? Maybe 1 year on a $3 million deal, something like that?
For sure, 1 year out of the box. Okay. I feel really comfortable with that. And then depending on what loan term you go with, say maybe you go with a 12-year term versus a 10-year term, I could maybe see doing 2 or 3 years. But that's all depending on, we have to look at the exit analysis at the end of the day.
So borrowers or customers cannot go to Fannie or Freddie directly. They have to go to companies like Old Capital. So my suggestion would be is contact an Old Capital loan officer and kind of go through that with them and kind of figure out what the right direction is. Anything more to say about that, James?
So let's drive down I-45 and let's go down to Houston and look at one more deal, if that's all right.
Keep going.
So let's say $5 million purchase price down in Houston, maybe $500,000 in rehab, 100 units. How would you guys look at an acquisition like that in Houston?
So there's areas of the country with Fannie Mae that they have some concerns with for a lot of different reasons. It could be they have overexposure in that market, or there are certain economic conditions that they have a little bit of concern on. And one of those markets is Houston. I think a lot of it has to do with the oil exposure, the energy exposure in Houston. So on this type of deal, I think we'd probably be closer to 75 to 70% on an acquisition is probably the highest that Fannie will go. It's one of those markets that we as a lender have to get Fannie Mae's approval on to provide a loan. So it's a little different than a delegated model that I mentioned earlier, where Fannie has to sign off on everything prior to us, originating, rate locking, and closing that deal. So it would be up to Fannie Mae to make that decision. Yeah, so I'd probably say 70%, 75% loan to cost, probably a 130, 135 debt service coverage for this type of deal. And then in terms of interest only, you're probably maxed out at 1 year, I would think. I really wouldn't feel comfortable, over 1 year of interest only in Houston.
Freddie loves Houston. We do a lot of work in Houston. So
another jab to the face to Fannie Mae.
I wouldn't even waste your time with Fannie in that market. We don't need to pre-screen that deal. We do a lot of deals in Houston. We're, roughly, listen, it's going to be the same as Dallas. If it pencils out the same, you're a 125, 80% loan to value, 3 years of IO on a 10-year. Rates could be as low as 4.25 on a 10-year. It really depends on how affordable the property is. One of the other things that I would like to, just throw in a hard hook here is my legal costs and my appraisal costs are going to be, let's just go with half of what they would be to do a Fannie deal. So, that's extra money in your pocket right there as well. So no, we don't need to pre-screen Houston with the powers that be. We can go do those deals. And we, in fact, are doing a lot of deals in Houston. So I don't have the same types of issues.
All right, so we looked at 2 acquisitions. Let's, drive down I-35 and let's go to San Antonio. And let's say someone bought the property with a bank loan a couple years ago, let's say 2 years ago, and now they're coming back and they want to keep the deal for another 10 years. So they trying to decide on a refinance. They think the value is about $4 million, limited deferred maintenance. What would you guys offer on something like that?
I think John mentioned earlier that 2-year mark is, I think, really important with the agencies. And since you're at that 2-year mark, I would feel comfortable going up to 75% of value on that new appraised value after having that 2 years. So you'd be able to fix it for 10 years, take out a lot of your cash that you could initially put into the deal. As long as you've done the work, you've improved the property. The one concern I would have would if you really didn't improve the property a whole lot and cap rate compression just driven down or pushed up your value, I could see some concern being a little pushback on that end. But if you're doing the work, do a nice job, I would have no problem going up to 75% LTV at a 125 debt service coverage. If it's the right sponsor and it's the right deal in the right location, we could throw in some IO in there as well. I wouldn't feel comfortable any more than 2 years. That would be the absolute probably max I would feel comfortable with, especially on a 10-year deal, with 1 year probably being kind of most likely. So that's kind of where we would be in San Antonio. We love San Antonio market. We're seeing more and more stuff down in San Antonio. I feel really, really comfortable in that market.
Yeah, correct. Fritz is definitely right on that. The 2-year mark is definitely the, I guess the over-under that the agencies are going to look at hard. So by the book, I can go up to 80 and I can quote it exactly the same as Dallas or Houston. However, we are going to definitely scrutinize the deal a little bit more given the length of ownership, which is right around 2 years. Very important for us is going to be your cost basis. We're going to take a strong look at what you purchased it for, how much work you put into the property, what your total basis is, how long the property's been stabilized. If you did do some value add work, love to see a story of we did all the work in the first 6 months, took 3 months to lease up, and it's been stabilized for the last year and change. That's a great story. Another great story that I love to see is a local sponsor who's got a pretty solid portfolio in that market, decent net worth, decent liquidity, and it's not exactly like he's going to take this money and buy a brand new Mercedes-Benz and run away. So I guess the short answer is we are going to look at the deal on a very holistic level, and the more information you can provide us, the higher the likelihood that I can get to 80% loan to value with some IO on that deal. And that's probably the best way to put it. So it depends, but we can go up to 80 and we can go up to 3 years of IO on a 10.
Okay.
I love this compare and contrast type of stuff. Let me ask a question. Somebody from China, somebody from Canada, that's not a U.S. citizen wanting to buy a property here in the United States. What's Fannie's opinion of it? What's Freddie's opinion of it for deal sponsors? Can it be done?
If you're a foreign national not living here in the U.S., Fannie Mae has some reservations with even have you be a key principal in the deal. I think you could be a limited, obviously a limited partner in the transaction, but cannot sign the non-recourse guarantees. However, if you live in the U.S., but to say you don't have U.S. citizenship, we have been able to get around that. Usually, we just require that a couple of the KPs are actually U.S. citizens. So if you live here but you don't have U.S. citizen or you do not have U.S. citizenship, we can get around that, but foreign KP will be an issue.
Yeah, and just remember that I think the demarcation line is 25% equity interest in the deal. So anybody who has any more than 25% equity interest typically is going to be a KP, a key principal, a signer of the deal. This is a non-recourse loan, but we have carve-outs, bad boy carve-outs. We have to guarantee that somebody's tied to the deal that can stand behind the transaction. Even though it's non-recourse, we want to make sure that we have a live body or somebody to stand behind the transaction that's doing the right thing for the property. How about for Freddie Mac?
We can do foreign nationals is the short answer. I have a handful of deals that we are doing right now that are foreign nationals, and we do see that fairly often in markets like Miami, New York, and LA. For us, it's obviously we're going to underwrite the property and take a hard look at the property. We like to see that the sponsors do have experience. We love to see that they have lived in that market or they are local to that marketplace. The biggest thing that we're going to look for is sponsors that have solid net worth and liquidity. And when I say solid, I mean typically I'm looking for sponsors with net worth equivalent to the loan you're requesting. On a 4 national, I'm going to look to see that the sponsors, and one of the key things I want to emphasize is that the sponsors have a combined net worth of at least 2 times the loan value, and then a debt service or liquidity equal to about 1.5 years of debt service. But again, let me stress that that's a combined amount. So if there's 2 sponsors and you're looking for a $2 million loan, I'm going to look for a net worth of about $4 million and about 1.5 years liquid of debt service coverage.
And that liquidity, I also want to stress too, is that we want to make sure that we can source that liquidity that doesn't come out of Bill's bank, out of someplace that we can't track it. We want to make sure it typically has come from a big international bank, whether it is HSBC or CIBC, someplace that we don't have a problem with money laundering and things like that. So that's a big thing. We want to make sure we can source and track those monies. Anything more, James?
I think this has been great, just giving people an overview of all the different nuances in both of the programs. And it really, a lot of times, comes down to the specific deal. I mean, you have to really get in there, by market, by sponsor, by occupancy, by debt service. I mean, you guys have given a great overview. And
well, who won then, James? Who won? How did you score the fight?
I think it's going to come down to the actual deal. I don't know if there's one way to swing the vote on this one tonight.
I think they're both winners in my book. So I don't think it's a tie. I mean, not everybody is going to fit in the Fannie Mae box. Not everybody's going to fit in the Freddie Mac box. But James is absolutely right. It's going to come down to deal specific. And when you discuss that information, when you have an opportunity, please call Old Capital, talk with some of the loan officers over here. They can go in a little bit more detail than we just did in 45 or 50 minutes. And they can sit down and kind of listen to exactly what you want to do and kind of help you, consult with you, and help you make a decision on what is the best direction to go. So let's kind of go around and say thanks for everybody joining us on the Old Capital podcast and the Fight of the Century. We've had fun today. What else do we need to talk about today, James? Anything?
I think if you enjoyed this podcast and found it informative, definitely subscribe, number 1, to the podcast, and number 2, give us a rating in iTunes. 5 stars or more would be great, as it helps other investors find us and gives us the ability to find more guests like we had today to bring you better information every week.
That sounds great. Again, thanks everybody
for
their time.
listening
We
to
appreciate
the Old
it. Have a
Capital
good day.
Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.